When assets are at extremes, it's actually safer to buy them. And I'm going to show in this week's video exactly what I mean. This is especially true for people who want to retire strong. Buying at an extreme sounds extreme. It actually is a very safe thing to do with retirement money. I want to show you what asset I'm talking about and how to play it. Stick around. Hey everybody, this is RC Peck with Fearless Wealth. Our main goal at Fearless Wealth since we started this company in 1998 is to make sure people retire strong. That means no anxiety, no stress, eliminating market anxiety. I want to talk about one specific chart today, and it is at an extreme. And this is typically where people fade away or they don't pay attention to it, or they think, oh, I'm retired, I have to do, vanilla type things, boring things. But in fact, it's when a asset or a sector or an index moves to an extreme position where it becomes really safe to invest. So let me move over to the price charts and show you exactly what I mean. Okay, so look at this price chart here. This is a price chart of zero coupon bonds. So just think of it as the riskiest type of US government bond to buy. Risky from the standpoint of price volatility. So I probably should have just said price volatility and not risk. Because if you hold it the entire time, the last 200 years, you'll get your money back. But price volatility is high. So on this chart starts basically at the beginning of 2017 to right now. So we're looking at about 6 years of price. And in the middle of this price chart, there's a triple top. Right after the COVID bottom happened, zero coupon bonds had a triple top, and they fell about 57% in price. In the lower right corner, you see the bottom down there, which was last year, when most things bottomed last year. Now you see that green horizontal line. That's where buyers keep coming in, right? Buyers keep buying that thing. This is a zero coupon bond ETF. So the symbol is ZROZ. And we can see buyers keep coming in there. But that's not the main point here. I'm going to move to another chart in a second. What I want to point out is that's the biggest price fall ever for US Treasuries. Now, I'm just happening to show you the zero coupon bond ETF, ZROZ, but it's true with all Treasuries. We could look at TLT or BND or IEF or IEI, and you'd see a really, really big price fall. And I've talked about this many times. It's the biggest bond price fall ever in US history, and no one really talked about it. And I think the reason is because it hasn't done anything yet. It's still down there. You can look at this price chart and it's still down in that lower right corner. So basically what's going on, and let me go to a different chart here. Here's the federal funds rate. And the federal funds rate is the fastest, sharpest, steepest increase in the federal funds rate ever. The Fed took the rates from 0, and they're currently at 5.25%. Next week, Wednesday, is another FOMC meeting, Federal Open Market Committee meeting, and they're going to raise rates another quarter point. That means it's going to go to 5.5. I have a green line on there too. That's where ZROZ stopped falling. Right, so after the federal funds rate got above 4.25, there was a bottom put in with zero coupon bonds. Which you might be like, that doesn't make sense because the rates keep going up. It's not 5.25. It's not 4.25 now. It's 5.25 and going to 5.5 and maybe even 5.75. But people are basically saying, look, we know when rates crank up like that. This is why I wanted to show you the screen. Look when the rates crank up like that. They don't stay up there that long, especially when they're this steep, right? So there was a steepening between 2016 and 2019. They stayed up there for maybe 6 months. There was a steepening between 2004 and 2006. Those rates stayed up there for, let's just be really generous here and call it a year. And yeah, back then, in 94, between 94 and 95, they went up and they fell from there. So they can stay high, but they don't usually stay at the rate where the Fed has them, right? So let's say maybe a year is a max, at least on this chart that goes back to 1994. So a good amount of data here. And so what's interesting is people aren't talking about bonds. Now, when I manage my clients' retirement money, there's none of this like, well, you're this age and we'll put you in a 60-40 or a 70-30 or an 80-20. Because honestly, most of the time you want to be in the stock market because that's where the stability is and the safeness is and the growth is. But there's an interesting thing setting up, and that is just what's going on. And what I mean by just what's going on is no one's talking about zero coupon bonds or 20-year treasuries, which is the symbol TLT, or BND or IEF. It doesn't matter. They all kind of look the same. Now, here's the final point I want to make. There is a massive short position on bonds. Massive short, meaning people are expecting the price to fall. I'm talking about price here. So they're expecting the price to fall and yields to go up. Okay, now I'm talking specifically right now, I'm showing you zero coupon bonds. If you look on the price chart, 2018, if you can see my cursor, 2018 is the last time there was a huge short position in US Treasuries. This short position today is even bigger by large speculators. Those are hedge funds. It's even bigger today than it was in 2018. After 2018, actually it started in 2018, zero coupon bonds went from about, I have to squint, 90 to, let's just do easy math, 180. They went up about 100% after the large, I think back in 2018 was the biggest short position up to that point. Today, the short position is even bigger by large speculators. So there is still buying coming in. Zeros and TLT, I can show you a price chart of TLT too. They haven't fallen since the federal funds rate went to 4.25. They're holding strong. They, meaning all the people behind TLT and zeros. Let me just show you TLT here. It'll be the final chart I show you. I have this zoomed back out to 2003. So here's 2 decades of information. And what was nice is in here, let me get there was the Fed increased rates in here. Actually, let's just be very specific. The Fed increased rates from 2016 to 2019. So if you look here from 2016 to 2019, TLT, the price just kind of went sideways, right? So I'm pointing this out that when the Fed raises rates doesn't mean the bond market from a price point of view has to crash. And then the other time the Fed raised rates was 2004 to 2006. And if you look from 2004 to 2006, the price of bonds actually went up. So let me kind of pull this all together for you and talk about what I think is going on. No one's talking about bonds. People are talking about Tesla or Meta or NVIDIA. And look, buying those at extreme lows is a great thing to do if you want to retire strong, right? Buying NVIDIA or Meta or Intel or any of these massive companies that are not going out of business but have just been hit really hard, buying them when they are 50 or 60 or 70 or 80% off is something you want to do to retire strong. And I kind of see the same thing happening right now in setting up with bonds, right? There's a high probable idea coming into play. None of this video is for advice. You have to take on your own risk if you're managing it yourself or talk to your own advisor. So, buyer beware. This is only information, or this is information only. But we have a similar thing coming up where there's just a huge fall in bonds. No one's talking about it really because they're talking about all the things that are going on in the equity world. But with that huge short position, and with the history of the last time there was a huge short position and 100% gain in zeros, we might be setting up for something like that. And it may be when the Fed finally says, okay, no more rate increases. We're going to keep the rates this way for a long time or for the foreseeable future. And so there is absolutely some patience that are needed. Thanks everybody for being in my world, watching my video, even though it's free. Liking, subscribing, leaving a comment, all of those things matter. My videos will be changing soon. I am getting rid of my research service and my coaching service went away 2 years ago, and I'm solely going to be managing money only, specifically people who want to retire strong. So these videos will definitely change from this market review. I do these videos for my clients every Tuesday. We review the market in depth and their portfolios, so they have a lot of clarity on what is going on. And that's really important because you have to do more than just I trust and like my advisor if you want to retire strong. If you're curious how we would manage your portfolio, we do something called a portfolio x-ray to show you where your leaks are. It's pretty powerful. I don't know what you'd like best or love best about it, but you'll know when you see it. Interested in that? Go into the description and get on our calendar. But yeah, these type of market review videos will be going away very soon. And I do appreciate all of you for watching. Thank you so much, and I'll see you next week. Okay, bye.